Louis Gargour, the CIO and CEO of LNG Capital, says the question now is how it will happen, not if. Now, Louis, given the outlook, where should we be looking to put our money at? And when you talk about a default, is this a coordinated default with Greece actually remaining in the Eurozone?
Yes. The plan I think that Germany and the other core European countries have is a coordinated default after a recapitalization of the Eurozone's banks. So what we're seeing now, the machinations of governments are to recapitalize French, Italian, and other European banks, then orchestrate a default that's meaningful, because the 21% write-down we've had so far is not enough to make Greece more competitive.
So sometimes we get caught up, in these daily moves. Yesterday we were down, today we're up. What do we actually expect? Where would you put your money to be on the safer side? A lot more volatility to come.
Yeah, I got an email yesterday from my brother-in-law, and the safer bet is to say, be nimble, be able to get into instruments and get out of them very quickly. So looking for distressed opportunities or very small cap stocks is probably not the moment. Right now, if you get the macro moves right, i.e. the country risks, and then take a view on sectors. Now, the main themes are we getting a global slowdown? If we are, then you want to be...
What do you think? Are we going to get a global slowdown?
I think you actually are likely to get 2 quarters of global slowdown, or less than 0% growth. So look for consumer non-cyclicals. Look for inelastic consumer products. So sports marketing, sports franchises, things like television and other entertainment where you stay home. Look to short consumer cyclicals, big ticket items like autos. My view is to be neutral and kind of have a net approach that is close to zero, so that you're taking a sectoral view.
So bottom line, would you say investors don't try and be brave? Because it could be quite enticing. You look at all these banks fall by, 5, 6, 10%, and you say, actually, this may be a good buying opportunity because I can make a quick buck.
Yes. Now, what happened last month? End of the month, we got a short squeeze. Beginning of the month, it sold off again. So unless Europe comes through in the next few days before the end of the month, it's probably going to sell off again after the end of the month. Now, it might be a great opportunity to reset shorts.
Yeah, you're also very cautious, I guess, on Germany, which people perceive as the savior of everyone. Are you expecting a recession there? And at the same time, emerging markets haven't decoupled at all. If we're in a recession, everyone else comes down with us. Well,
the argument is that Germany is going to have 0% growth. And the argument is as well that emerging markets need to sell their goods and services to the Western world if the Western world doesn't consume as much. The problem with the emerging markets, as I see it, is that inflation rates and real growth rates are very close together. So the real growth rates are falling or actually lower than we anticipated, hence the equity markets have adjusted. So I think you need to be very careful about this decoupling argument, because emerging markets depend on the Western markets for their productivity and exports.
Louis, when you talk about portfolio which is market neutral, how much do you have in cash in this ideal portfolio?
This month we actually went into about 30% cash. Okay, we also had made money. We're up about 8 to 9% year to date. So we said, let's monetize that. Let's go into cash to be able to deploy, because cash is a scarce resource in this market. If you're down on something 10 or 15%, you're loath to sell it. If you've sold it at a small profit or a small loss, you can reevaluate whether you want to enter. So I think a long-term view is a good one, but right now be nimble and be dynamic.
And what about gold? This is, again, something which really has our investors split down the middle.
Well, I was in Switzerland speaking to some very important heads of banks a couple of weeks ago, and they said our key bets are gold, non-dollar assets, Singapore dollar. Now, gold is a great repository of value in uncertainty. If there's a rally and a solution to Europe, gold sells off. So I think it's a direct knock-on effect of the ECB potentially coming up with a plan, and Germany and Merkel and the rest of the European governments doing something proactively. So gold is, if you will, the direct opposite of Europe sorting out its problems.
And you say that, crucially, if they sort out their problems, what kind of time frame are we looking at? If we have some piece of, I don't want to say good news from the ECB, but whether they buy covered bonds or whether they cut interest rates, is that going to be a catalyst for the markets?
I think so. I think if the ECB says, why the ECB, first of all, do I have another 30 seconds? The ECB is already collateralized and guaranteed by the countries, right? So the ECB is probably the best mechanism without formally changing constitutions and arguing and politicizing.
They're the only mechanism.
Precisely. So they could tomorrow say, we're going to borrow money and redistribute it to European banks and countries that need it. We're going to borrow 8 times the emergency funding mechanism, so maybe, $5 billion, and give $2 billion to banks. It could happen quickly. So the market now is rallying because it knows that finally Europe, maybe Geithner had some effect on them, is going to get its act together.
And so as soon as that happens, you'd be, taking a bit more risk on it?
Let's think about it. What would you do? I maybe look at banks as being cheap. Berkshire Hathaway has said that there are sectors that are cheap. He bought into Bank of America. If there's a bailout of banks by the government, all of a sudden they look very cheap.
Yeah, so all we need is that signal, Louis.
Precisely.
Thank you so much, Louis Gargour there, CEO and CIO at LNG Capital. Well, thanks for sharing, of course, your investment strategy with us.
Thank you.